Let's now move on and get the CLSA view on the Indian market in 2025. We have Vikash Jain joining in. Vikash, great to have you with us. Greetings of 2025. Wish you a very happy new year. So let's just take forward the conversation that we were having now. The thing is, as we've entered this year, there are too many moving parts, from the US economy to yields to dollar to a slowdown in earnings. Let me start with the last one first, because that's the India controllable, right? How optimistic are you about the second half earnings revival?
Well, I think there's always many moving parts when you start the year, and that's why what we do at the start of the year is we come out with a typical report, which is a very well-read report by our clients. It's called Themes for the Year, and this time we have 25 themes for 2025, and we discuss a lot of what you mentioned. Earnings. See, more than what I feel, I think it's also trying to understand where expectations are, where consensus is. Firstly, we at CLSA, we are about 2 to 4% below consensus as we start the year. And more importantly, when I look at just our numbers and certain key drivers that moves the earnings, that's the moves the big stocks that determine the overall Nifty earnings. There is an assumption of normalization happening rather quickly in terms of growth in FY26. For example, things like credit growth. We are right now sub 11% credit growth. Broadly looking at the numbers that our team has baked in, somewhere closer to 12 to 13% is being assumed for FY26. Similarly, for commodity prices and profitability, we are assuming that things will improve. So there is a recovery that is baked into our numbers. And our numbers are a little below consensus, so that maybe consensus baking in a little bit more of the recovery. Now that is just normalization of growth. Now the process of normalization, if it is a little slower than after the weak GDP number that we saw in the second quarter, then there is obviously risk to earnings in FY26. If you remember the last quarter, we saw pretty big downgrades in earnings. So, further downgrades can be a bit problematic in terms of expectations of Nifty returns.
You're at 12 to 13% for FY25, Vikash, if I got that right, correct?
That is, we are at 12 to 13% of credit growth. The earnings number that consensus is baking in for FY26 is Nifty earnings growth is about 16%. We'd be slightly lower than that.
Okay. Vikash, hi, morning. Prashant here. So what I'm hearing is caution. So give us a directional view. Put it out there. What is your best sense? Lots of things in the mix, but you got to take a stand. So what's your sense?
No, absolutely. I think that's what we have done. So I'll tell you, India's expensive valuations is what is being talked about by everybody. What we have brought out this time, looking at the start of this year, is I am actually quite worried about the fact that Indian bonds, as compared to where the parity should be versus, say, US bonds, are looking more expensive, and Indian currency is looking more expensive. And both of that is what sets up, and particularly in the next 4 or 5 weeks where macro is going to be very important and big, that could be a little bit of a problem. Let me explain that. So last year, we did not have any cuts from RBI, but Indian bond yields fell by 50 bips. In the US, Fed had several cuts, but US bond yields settled up by 80 bips. So Indian bond yields effectively outperformed by 130 bips during 2024. Currently, the differential between US and Indian bond yields, 10-year bond yields, is down to just close to 2%, a little over 2 percentage points or so. Now, to a naked eye, of course, that's one of the lowest we've seen in the last 18 years, but I'm less bothered about it because what I show in my report that this is something which tracks very closely with what is the forward market currency depreciation expectation. And that is more like 2.7%, 2.8% or so. So everything kept together, there is a chance, if US yields do not do anything, then Indian yields need to go up by almost 50 bips for us to get to that parity. Now, if we imagine that happening, and even if we assume that the bond and equity valuation differential remains at the bullish end, that is the max differential for earnings yield versus bond yield, and we go from 6.75 to 7.25% bond yield, then, we're struggling to get anything more than 2-3% return on the market. So I would say it's going to be tough to, and that too in the bull case, if there is a 50 bips move in bond yields. So we need bond yields to not go much higher, and also at the same point of time expect that equity and bond differential stays very high, and we do not see earnings cut. I think that's a lot of things which are uncertain, and that's why I would say that not gunning for big returns, single-digit returns will be. If we scrape through with that, we'll be very happy with that. So there's going to be a period where things will go much cheaper, and then we can come back to hope for an up move. But net, don't think we're going to end with a very high number versus where we started this year.
Okay, all right. Hi, Vikash. Good morning. Good to see you in. You're sounding a little bit cautious, or little bit would be an understatement. Worst case scenario, what do you think in terms of a downside from the Indian markets? We're 10% off the peak. How much more downside?
So let's not even take worst case. If you were to say that because of concerns of near-term growth, our valuations kind of normalize at 6.75% yield and assume that yields do not rise, which is going to be difficult because that will mean US yields have to fall. Then even at that, just getting back to normalized differential versus bonds, we're looking at end of the year Nifty fair value at that scenario at 23,000. So even under that scenario, there could be downside for the market. So not really gunning. I think, we've had a great run. This could be that year of consolidation following, which started in October. That might very well continue. I would say if it's a very orderly kind of a correction and we scrape through with earnings catching up and valuations becoming more palatable, that's the best scenario one can imagine for the market.
Because those in it for the long term hold on and kind of hope to ride through 25 and look forward. I mean, that's the way for long term investors. But those more tactically oriented, are there anything things to do to protect the gains you've made, where you think we could see damage, take advantage of anything out there?
So I would say that most likely sometime during this year, maybe in the first half, we end up having a correction, and that could set us up for a great entry point for a lot of people, even the long-term guys, and even the ones who want to benefit on the long side once that period is done. See, first half is going to be very, very macro heavy. When Trump comes in, he's obviously not very predictable. What all does he do? What impact that has on the dollar? What impact that has on currency? Plus, we have our own.
Vikas, have you modeled that when you say correction in the first half? I mean, is there any way to say what are we looking at? We're at 23,600 or so right now.
Thankfully, I don't have to do that difficult a job of predicting Nifty every month. So that's why we typically take a 12-month view. So that's something which I think a technician, maybe our colleague Lawrence, can do a much better job with. But
so what is he saying? Is he in agreement with you? We get a first half swoon?
I think he's obviously saying that the charts are not looking that great for India. I think that's something which he's been maintaining. I'm sure you guys talk to him more often. So he'll be the right one to speak about that.
So possible 7-10% kind of a sort of, I mean, that would typically qualify as a correction. I mean, if it's...
We already had a 10% correction, Shant. So we actually called for it around October, where our India Bull Bear Index, the sentiment gauge, gave us a signal around end September that this is at an extreme bullish point, and we called for that.
Okay.
But you're saying from here you get a bit of a correction, right? H1.
See, I am saying that because of the macro setup. I am saying that,
I'm just saying, I'm just confirming. And so
that's
then
right.
from here, what do you see? You've already seen 10, another, 5-7%?
So,
and then that's the entry point?
So if you see, we are at about 19.5 kind of a PE right now. If you were to go down another 10% or so, then that would take you to very close to where the mean reversion should be to go to historical average valuations. And given the way India is positioned over the slightly longer term, which looks much better than most other economies, if you get the market near historical average valuations for a multi-year period, that's a great entry point.
Vikash, just to finally complete the picture, I just want to put up that chart that we had on with the underweights and overweights that CLSA has, just sector positioning. They're underweight on a lot of things: IT, discretionaries, industrials, and even healthcare. The overweights are only commodities and insurance. So Vikash, as you sign off, Commodities, and obviously the market took note of your call specifically on Reliance Industries, which came out earlier this week. Just leave us with some, some broad setup in terms of hiding places, because you sort of outlined the underweight sectors. On commodities, is it just oil and gas, or in general, are you expecting metals to also, move up? Just leave us with the explanation behind that construct.
In fact, you missed one sector. Our biggest overweight is actually staples. So we run a India-focused portfolio, and for the last 4 years, I've tended to completely avoid staples. And this time, at the start of the year, we've actually made staples our biggest overweight, cut our overweight in banks to just above neutral. And commodities, we have 4 names. We have metals as well, and oil and gas names as well. So staples, I believe that that's really the big sector call, which we have taken very anti-consensus. The kind of underspend that we have seen on government capex, both at the state level and the central level, I think that is also maybe hinting us on government's changing priorities. If that happens, the investment and the capex linked stocks are already overexcited and at elevated valuations. But if priorities change to more welfare, affordable consumption side of things, then that's the sector which is, pretty beaten down, because it's not done much for a lot of time. That's why we believe that the realities of coalition government and the hints that we have got from recent state elections, plus the good rainfall that we've seen and the good sowing that we've seen, maybe just bring back that affordable consumption to to kind of life. And within staples, we like the food-related companies more.
All right. Vikash, great chat. And, let's book you for right after the 20th of January, because I think there'll be, we'll see. Reuters says over 20 executive orders on day one, and then we'll take it from there.
He's going to hit the road running, and that's why it's going to be very macro heavy.
Absolutely. Thank you very much. It's a pleasure, and speak to you soon again. Look forward to our next one. We'll take a quick